Hey everybody, welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another Velocity Banking review. And I just did a quick Google search on should I save money? And you'll notice that pretty much every website on the top search results are telling you that yes, you should save money, right? Top 7 reasons to save money. Um, Let's see. If I scroll down here, the big banks, Bank of America, simple ways to save money for the future. Discover top reasons to save money. How much money should you save every paycheck? Consumer Financial Protection Bureau, an essential guide to building an emergency funds. Without savings, a financial shock, even minor, could set you back. And Fidelity and Chase Bank, and it goes on and on and on. So you ever notice that these top results are from the people who have an interest in the banking system? And what we're going to do is just kind of do the opposite. And just to confirm my little premonition or suspicions of whether I should save money or not, I asked ChatGPT, would banks prefer you save money or pay off debt quickly? Right? And let's go ahead and play that response.
Banks generally prefer that you maintain both savings and debt balances rather than aggressively paying off debt or saving too much. Here's why. Why banks like you to save. 1. Deposit funds for lending. When you save money in a bank, it increases the bank's liquidity. This allows them to lend more money to other customers and generate income through interest. 2. Cross-selling opportunities. Savings accounts provide banks with opportunities to market additional financial products like investments, credit cards, and loans. Why banks like you to keep debt. 1. Interest revenue. Banks make money from the interest you pay on loans, credit cards, and mortgages. If you pay off your debt quickly, they lose this steady income stream. 2. Extended relationship. Carrying debt over a long period allows the bank to collect more interest, strengthening their financial return on the loan. What banks don't prefer? 1. Paying off debt too quickly. While some loans allow early payoffs, banks may include prepayment penalties to discourage it. Paying off debt quickly means the bank earns less interest. 2. Draining savings for debt. Banks worry about customers using up all their savings to pay off debt, as this could increase financial instability and the risk of loan default. The sweet spot for banks. From the bank's perspective, an ideal customer is one who maintains a savings account balance, makes consistent loan payments over time, occasionally borrows more money, e.g., for a home, car, or other purposes. If you're strategizing your finances, it's important to align your goals with what benefits you, not the bank. For example, using strategies like velocity banking can help you pay off debt quickly while leveraging financial tools to grow your wealth.
So you see that sweet spot? You got to maintain a savings account and just make payments over time. Don't pay them off too quickly, right? Don't pay them off too quickly. And here's the thing, right? If you ever look at mainstream financial advice, they always talk about saving money, but in order to pay off debt. But I've gone over situations many times where people are in negative savings and it's like how do you even save money then, right? You're in negative savings, okay? More income than expenses, and we're going to show you how to overcome that potentially with this thing called velocity banking. And what is velocity banking? All it is a debt payoff strategy where you use a line of credit as your main operating account. If you want to break it down, it's just no savings and all your money goes into a line of credit, right? All of it goes into debt. Okay. All right. So, one question you might be asking is what's a line of credit? So, I like to call this my little infinity gauntlet, right? I remember when I first got it, I was like, yes, I feel like I feel like I have this incredible source of power in my hands, right? So, think of it essentially like a credit card. Well, technically, all it is a financial tool where you could borrow money, pay it back, and use it over and over again, right? So your credit card fits into the category of line of credit, but I have this thing called a HELOC right here, home equity line of credit. If you have something called home equity, you could provide it as collateral to the bank, and I could literally just with a click, not a snap, but with a click, go to the bank's website, and they will deposit $280,000 up to $280,000 in my checking account at a 7.75% interest rate. Okay. 7.75% interest rate. And so we're going to use this as our main operating account and we're going to dump all of our money into it. That's all we're going to do. Okay. Now, let me just go here. All right. So, first of all, we can't even save money, right? Even if we did, it's going to be very hard. Okay. So, we assume two things. Number one, we have the same income. And then number two, we have zero savings, right? So, we have absolutely no savings, but the same expenses here. And then our income minus expenses is going to be what we call our cash flow, right? And then we're going to assume we have access to a $150,000 line of credit. I think it's $150,000. Is it 150,000? Yeah. Okay. And how much credit card debt is it? Let me do a quick calculation. Hopefully, I'm not making you all dizzy. 5 plus 8 plus 15 plus 27 plus 30 plus 7 plus 10 plus 35 plus 12. Okay. $149,000 of credit card debt. So that's one of our first goals, to eliminate $149,000 of credit card debt. All right. And then the cash must flow, right? So we're going to make our cash flow by moving some debt. So once we've moved some debt into a line of credit, we're going to put our entire paycheck, this $10,000 in, which is going to do two things. It's going to satisfy the minimum monthly payment. And then it's also going to minimize the interest because the interest is calculated on the average daily balance, right? And so let's go ahead in this $150,000 line of credit, move our credit card debt, 149,000. Okay. So once we do this, this is a debt transfer, right? Now this will go to zero. So we literally went from negative $989 to $3,771.27. How do we do that? Must be magic. I don't know. But all I know is that with a click of a button, we can literally go from a negative savings to a positive cash flow. Literally. Snap. With all 5 of my infinity stones. Is it 6? I'm sorry. I don't even know how many infinity stones there are. But yes, with my $280,000 home equity line of credit. And I actually have over $575,000 in lines of credit. I think it's 576. I can't even remember anymore. And that's when you have too much credit, right? Too much credit because you can't even remember. One day it'll be over a million. I don't know, maybe in a year or two it'll be over a million. Like, that was a lot easier than I expected it to be, right? 575,000. But okay, so now we just kind of do this, put our entire 10,000 into the line of credit, take our expenses out, and then rinse and repeat over and over again. And after every single month, the balance will go down by $3,771.27, right? All right, so now let's just do the formulas that we always do, folks. And then we're going to subtract our cash flow, 377.27. So how do you get the next month's balance? It's previous month's balance, previous interest minus the cash flow. And then what we do is we take the interest, right? In order to get the interest, it's based on the average daily balance, multiply by 8% and divide by 12. And then what you do is you just copy and paste these formulas and they will lead you to the right path, hopefully. And then we see that in about 46 months, it is all paid off. It is all paid off. Sweet. Okay, so now we just write this as a milestone. 46 months to pay off 149K. And then we're going to copy and paste, right? We're going to copy and paste. And then we got to tackle these debts, right? And I don't think I set up the loan calculator correctly. So you could see me calculate it in real time. All I gotta do is copy and paste these, right? I just got to delete this one. And then I got to redo all of this stuff. And so 30. Oh, wait, did I screw up? Oh, no, I did. Okay, my bad. Let me copy and paste this. And let me redo this again. Sorry. I know I might be going quick for some of you all, but this is, you do this so many times, it's so easy and natural. And so some of you are all freaking out like, why can I do this quickly? And that's kind of like a big problem in our society. where we expect that people are able to learn things just from one session, but that's not true. All right, 6.1%, 3%, and then 30, 10, 5, 5. Okay, sweet. Okay, so what month are we on? We are on month 46. So what did I just do here? Basically, I set up a calculator um, that allows you to auto calculate the payment amount based on the original balance, interest rate, and the loan term. And if you give it the current month, it will also give you the latest balance, right? So all I gotta do is just put the current month right now. Yep. Now let's put the month, and I just totally forgot it. Oh yeah, month 46. And then do 46, 46, 46, 46. And then now I know just from looking at these calculations, and if you don't know what this is a cash flow index. Let's look it up. Cash flow index. It's just a scoring system or a ranking system that helps you determine which debts to pay off quickly, right? How to use the cash flow index to quickly and safely eliminate your debt. So think of this as a ranking system, right? The lower the rank, or the lower the number, that's the one you want to pay off first. So I'm going to pay off these two first, okay? So I'm going to do this, G2 plus G3, and we're going to pay off these two auto loans, right? And guess what happens here? Well, I just move these two auto loans into that line of credit. And then, right, so this is going to be plus 22746.25. What happens next is that since these two auto loans are paid off, they go to 0, 0, 0, right? And then our cash flow is now over $5,000. Oh, wow, this is so amazing. I can't believe it. I cannot believe it. All right, so let's go ahead and copy and paste this. And then now 5459.09, that's our new cash flow. And then this is going to be month 51, and it's going to be 149 plus 45 plus 42. We've paid off $236,000 of debt. Look how easy that was, right? And then now it's time for the student loan. So let's go ahead and pay off the student loan. 51 months, so these two are 0, 51, 51, and that's 35 grand. Okay, we can move into a line of credit. 35 grand, it's not that much, so let's go ahead and do that. And then I'm going to just do this, 35 grand, copy and paste, plus 35621.92, right? And then now we freed up some cash flow in the student loan, $613, so it's not that much. And that's why we got to be careful about which loans we move into that line of credit. All right, so let's need this one right here. So now our cash flow here is 6072.47. And then we see right here in 57 months, that student loan is paid off. 57 months. Boy, that was easy. Okay. So 236 plus 57. Okay, now last one. Okay, so let's go ahead and update the loan calculator at 57 months. And then we take a look here. Look at this cash flow index number above 100. Very, very high. What does that mean? Well, basically, if you pay off this $196,000 of debt that's left, you get this itty bitty $927 back in your cash flow. That's all that means, right? Now, here's the thing. Just because this is high doesn't mean we shouldn't pay it off, right? Some might argue that, but I'm like, okay, well, here's the thing. If I let this thing go for 360 months, look at the total interest that I pay. It's about 50% at a 3% interest rate, right? So we don't want to even at a 3% interest rate, it's not what you think it is, okay? So what we do as an easy way to pay it off is do something called chunking, right? Just move some of that debt into a line of credit. Pay, put all your paycheck into it and then rinse and repeat over and over again. Just a small amount. It's relatively easy. I can't believe how easy it is compared to just directly overpaying the loan with your savings. Now, I met this gentleman, okay? He was like, "Well, I'm only paying an extra $100." And the mortgage was his only debt, right? But I think he had a savings account, and he says, "I'm just paying an extra $100 into my mortgage, and I know I'll pay it off 1 or 2 years early." And so, what's the hesitancy of putting your entire paycheck, 5,000, 7,000, into your debt? It's because you know that when you make an extra payment, okay, when you make an extra payment, that money is gone, right? Now you can use a line of credit as a backup. Of course you can. But then now you're going to segregate your income. That's another problem that we haven't really talked about in this video. So we're not going to do that. We're not going to segregate our income, but we can easily calculate if we just do this chunking method. Okay. How quickly are we going to pay it off? Relatively quickly. Okay. So let's go ahead and do this and whip out the velocity banking calculator. So all I got to do is just put in the numbers here. And what's this right here? So $220,000. So I just got to fill in the numbers, right? So 200, and let me do this. 220000, right? What's the current balance? It's 196,903.08. 196,903.08. And then it's going to be 927.53, 927.53. And what's my monthly income? I don't even remember. That's what the budget's for. Ooh, $10,000, not bad. 10,000. And then what's my expenses? It's everything except for the loan we're trying to pay off. So with the 3,000 is my expenses. So 3,000. And then how much am I going to chunk to a line of credit? You could just do a small amount, like your paycheck, 10,000. Ooh, look at that. 2.5 years. 2.5 years. Okay, so how long did it take us to pay this off? It's just 57 divided by 12 plus 2.5. That'll be 2.25 years to be completely debt free, right? Completely debt free. And then that's it, right? So how much debt was that? That's 293 plus 220, so it's 293 plus 2. Oopsie, can't even write. 293 plus 220. And where's the equal sign? 513K. 513K. And we started off flat broke in the negative savings, right? So, all right. So, what do you think? Do you think we should save money? Because I don't really have any money saved, but I do have my line of credit as my main operating account. In fact, I paid it off so quickly. Now it's zero. In fact, I paid off my mortgage in 3 years. I don't even know where the screenshot is for that because I accidentally deleted it, but it's all good. It's all good, right? Once you get one of these babies, man, you see it for the first time, you log into your bank account, you really do feel like this, You really do feel the power of the infinity gauntlet, aka your home equity line of credit in your hands. All right. Well, this is Korean Atlanta Mentorship. Have a great day and subscribe to the channel. What do the YouTubers always say? Leave a comment, like, and subscribe. Okay.